Welcome to The Explainer. You ever wonder if there's a way to get better than average returns on your money without basically just gambling? Well, today we're diving deep into the playbook of an absolute giant of investing, Benjamin Graham, to unlock his strategy for what he called the enterprising investor. It's a method that really shows how putting in the effort can lead to some truly extraordinary results. Okay, first things first, let's bust a huge myth right out of the gate. When Graham uses the word enterprising, he is not talking about a speculator, some daredevil rolling the dice for a huge payday. Just look at the difference here. The goal isn't just about taking on bigger risks. It's about putting in more work, kind of like a detective, to get a better and, believe it or not, often a safer result.
So what does it actually take to be this kind of investor? Well, it really boils down to three key things. You gotta have the time, you need to develop the skill, and maybe most importantly, you have to have that genuine desire to really actively manage your own portfolio.
And this quote from Graham himself just cuts right to the heart of it. There's no halfway. You can't just dabble in serious analysis and expect to get professional level returns. His point is crystal clear. You either commit 100% to doing the work, or you're better off just choosing a more hands-off defensive approach. So if you are that person, if you're willing to roll up your sleeves and put in that effort, Graham doesn't just leave you guessing. He actually lays out a map with 4 very distinct paths you can take to hunt for those superior returns. And this slide here gives us the entire framework at a glance. Graham's 4 paths are timing the market with a specific formula, carefully picking growth stocks, hunting for deep bargains, and navigating what he calls special situations in companies. So let's take a look at what each of these really means.
And you'll notice these are not just vague ideas. For market timing, he gives you a strict formula to take all the emotion out of buying and selling. For growth stocks, there's a firm valuation cap to stop you from overpaying. Now, that 4th path, special situations, that's really for the pros. But it's the 3rd path, hunting for bargains, that truly captures his core philosophy. And it was his absolute favorite.
So yeah, while Graham laid out 4 valid paths, he had a clear favorite. It's a strategy that gets right to the very heart of his philosophy, the art of hunting for and buying undeniable, rock-solid bargains. He called these net current asset stocks, or net nets. Now that sounds a little technical, but think of it this way. You're looking for a company that's so cheap, its stock price is actually less than the value of its cash, its inventory, and what it's owed after you pay off all its debts. It's like finding a business on the stock market's ultimate clearance rack. This slide shows you exactly how it works. I mean, look at these numbers. The stock is trading for 20 bucks. But if you calculate its net current assets per share, the stuff that's easy to sell off, it comes out to $30. You are literally buying $30 worth of assets for a $20 bill. That gives you a huge immediate advantage. What's amazing is that even Graham himself seemed kind of blown away by how simple and powerful this idea was. He basically said that for over 3 decades, this super straightforward strategy of just buying a diversified basket of these bargain stocks worked incredibly well. It gave him a massive cushion against any losses. And hey, this wasn't just some theory he came up with. He pointed to real-world examples, like a company called Burton-Dixie Corp. Investors who bought this stock when it was on sale saw a 167% gain in just 3.5 years. I mean, that's an almost 47% return every single year. It just proves that being patient with these unloved bargain stocks can pay off big time. Now, all of these strategies, every single one of them, are built on one single ultimate rule. It's the core concept that supports Graham's entire philosophy, and it's what protects an investor from, well, the future. So what is it? What's the one big idea that ties market timing, bargain hunting, and even growth stock investing all together? What serves as your ultimate defense against the craziness of the market? The answer is the margin of safety. And this flow chart shows you how it's the final gatekeeper for everything. See, you do all your analysis, you crunch the numbers, you look at the quality of the business, you check the market's mood, and all of that helps you estimate what a company is really worth, its intrinsic value. But then, the final step, you see it there in yellow, is asking, is the price I have to pay today significantly less than that value? If the answer is no, you walk away. That gap between the price and the value is your margin of safety. And let's be really clear, this is not just a nice to have. It is the core discipline. It is your built-in buffer against a future that you just can't predict. It protects you from your own mistakes, from bad luck, from a sudden market crash. It's the final bouncer at the door for every single investment decision you make. Okay, but this brings up a huge question, right? Graham wrote all this decades ago. Does this old school wisdom really still work in our modern, super fast-paced, high-tech markets? Well, the evidence says absolutely yes.
History gives us a really powerful lesson here. This chart tracks different kinds of stocks over decades. Now notice, in the boom times, the popular big-name stocks, that blue line, they just pull away. But now, look what happens in the recovery after the Great Depression, from 33 to 37. Those undervalued secondary stocks in red and orange, they just went ballistic, delivering massive returns because they started from such a low, unloved price.
And this brings us right to the biggest trap in modern investing, a point that commentator Jason Zweig talks about all the time. We fall in love with these amazing, innovative companies, but we completely forget the most important rule. A great business can be a terrible investment if you pay too high a price for its stock. Just think back to the darlings of the late 90s. Companies like General Electric and Home Depot were fantastic businesses. They had incredible earnings growth. But investors got so excited that their stock prices grew even faster than their earnings, reaching these totally unsustainable levels. And when that growth slowed down just a tiny bit, the stocks completely collapsed. And this is especially true when it comes to IPOs. The hype machine just goes into overdrive, and investors get totally swept up in the story. We all remember the huge winners like Microsoft, but we have this survivorship bias. We completely forget about the thousands of other IPOs that just crashed and burned, taking investors' money right down with them. So what this all boils down to is a timeless 4-step action plan. Number 1, demand a margin of safety on absolutely everything you buy. Number 2, diversify across a good number of stocks. 3, use a disciplined formula, not your feelings. And 4, maybe the most important, always remember the difference between a stock's flashing price on a screen and the real value of the business underneath. And that leaves us with one final, pretty challenging question to ask ourselves. When you look at your own approach to your money, are you truly doing the rigorous, analytical work of an investor, or are you maybe just taking the risks of a speculator and hoping for the best? Graham's work shows us there is a better, a safer, and ultimately a more profitable way.